Welcome back, everybody, to another deep dive. Today we are tackling an investing classic, A Random Walk Down Wall Street by Burton Malkiel.
Yeah, a must-read for anyone who's, well, ever thought about investing.
Absolutely. And we've got our highlighters and notes ready. Trust me, there are a lot of big ideas packed into this one.
Really makes you think differently about how the market works.
For sure. The core idea, just to kind of set the stage, is that picking stocks is, well, a lot like a random walk. More about luck than skill, maybe.
That's Malkiel's big argument, yeah. He's really diving deep into the whole efficient market hypothesis.
Yeah, that thing. Which basically says stock prices already factor in all the information out there, right?
Exactly. So trying to, outsmart the market, it's a tough game to win.
So like those stock-picking gurus we see on TV. Maybe not the all-knowing oracles they pretend to be.
Malkiel definitely pokes some holes in that image. He looks at two big ways people think about how stocks are valued. There's this firm foundation theory, which is, I think, pretty intuitive.
Yeah, what's that one?
Basically says a company's worth, its intrinsic value, should be reflected in its stock price. Makes sense, right?
Yeah, like a good solid business should have a good solid stock.
Right. But then he's got this other theory, the castle in the air theory, where it's all about, emotions, speculation,
Okay.
hype driving prices way beyond what a company's actually worth.
I see where you're going with this. So are those like those infamous market bubbles or those castles in the air?
Exactly. And Malkiel uses some pretty wild historical examples to illustrate this point. Have you ever heard of tulip mania? Back in 17th century Holland?
I have heard of that. People were trading their houses for tulip bulbs.
It was insane. Bulb prices went through the roof. People were going crazy for them. There's even a story, a sailor, I think, mistook this super valuable tulip bulb for an onion.
Oh, no.
And ate it. Just shows you how detached from reality things became. But Malkiel's point is that this kind of frenzy can happen with anything, not just tulips.
Right.
He brings up the South Sea bubble, too, in 18th century England. This company pops up promising everyone they'll get rich from trade with South America, even though they had zero track record.
So like a pump and dump scheme?
Kind of, yeah. Investors just piled in, the bubble burst, and tons of people were left holding the bag.
So trying to time those bubbles like buying in low and selling high, it's a fool's game.
Malkiel would definitely agree. He even quotes Gustave Le Bon, who wrote about crowd psychology. Basically, when emotions get involved, logic goes out the window.
And bad decisions get made.
Exactly. It's like a recipe for disaster.
Okay, so we're not riding any speculative ways.
Got it.
Ah.
What does Malkiel actually suggest instead?
Well, he really gets into the nuts and bolts of investment analysis. He breaks down the two big approaches.
Yeah.
Technical versus fundamental analysis.
Okay, yeah, I've heard those terms thrown around.
Technical analysis is all about charts, patterns, people trying to predict future movements based on past trends.
Ah, like the head and shoulders formations I see on those fancy trading screens. Yep, that's the idea. But Malkiel says there's really not much evidence to support that it actually works.
Oh, okay. So what's the other one?
Fundamental analysis. That's where you're digging into a company's financials, industry trends, really getting a sense of the whole picture.
So actually understanding what the company does and if they're doing it well.
Exactly. But even with that, Malkiel did this research showing that even professional analysts, they often miss the mark when it comes to predicting earnings.
So even the experts with all their fancy degrees, they can't consistently get it right. That's kind of reassuring for the rest of us.
It is. And it kind of brings us full circle back to the efficient market hypothesis, right? It's almost like the market is this giant sponge soaking up every bit of information instantly.
And reflecting it in prices so nobody can really get ahead. Okay, I'm kind of getting it now. Let's unpack the EMH a little more. I've heard it comes in different, levels.
Yeah. So there's the weak form, which is basically saying past prices are no use for predicting future ones. Then there's semi-strong, which says all that public information is already baked into the price.
Okay.
And then there's strong EMH, which takes it even further, saying that even insider information wouldn't give you an edge.
Whoa. So if EMH is really true, are we all just playing a game of chance here?
Malkiel kind of leans that way, yeah. He argues that beating the market, consistently, is incredibly difficult. Prices just adapt too quickly to any new information.
But then how can we see those crazy market swings? Like the bubbles and crashes. Shouldn't an efficient market be more stable?
That's a great question, and it leads us to this whole other area. behavioral finance. It's kind of like a challenge to the efficient market idea.
So now we're adding in the human element.
Haha.
Right. This is the things get interesting, I bet. Tell me more.
Okay, so behavioral finance says basically investors aren't always rational, right? Our emotions, our biases, they can mess with our decisions. And that creates those market hiccups that seem to contradict the whole efficient market theory.
So you're saying we're all prone to making, like, irrational money moves.
Yep. Malkiel goes into some specific cognitive biases that can really trip us up. One big one is overconfidence. We tend to, overestimate our abilities, thinking we can time the market perfectly.
Oh, I know that one. This is like the "this time is different" track.
Exactly. And then there's confirmation bias. We tend to seek out information that just supports our existing beliefs, even if it's wrong.
Ooh, that's dangerous. Like only reading news that agrees with your stock picks, even if it's all hype.
Yeah, exactly. Then there's the herding instinct, following the crowd, like everyone piling into tech stocks during the dot-com bubble.
Good old FOMO, fear of missing out.
Right. And then finally, we've got loss aversion. It basically means it hurts more to lose money than it feels good to gain the same amount.
Ugh, I feel that one in my bones. So we hold on to losing stocks for way too long, hoping for a miracle.
Exactly. But if we're all so biased, how can the market be even remotely efficient?
Right.
Well, the classic argument is that this thing called arbitrage kicks in to sort of correct things. Basically, savvy investors exploit any price difference, make a profit,
Oh, okay.
and theoretically, all that buying and selling should push prices back towards their true value.
So arbitrageurs are like the market's cleanup crew.
That's one way to think about it, yeah. But Malkiel, along with some other behavioral economists, they argue there are limits to arbitrage.
Oh, really? Even those financial wizards, they have their limits. What holds them back?
Well, risk is a big one. A lot of arbitrage involves borrowing money, which can amplify losses if things don't go as planned.
Makes sense, yeah. Nobody wants to lose their shirt, even for a sure thing. So arbitrage isn't like a perfect fix.
Not always. And sometimes it's tough to even find those comparable assets for arbitrage to work, You need two things that are basically the same but priced differently. Malkiel uses this example of Royal Dutch Petroleum and Shell Transport.
Oh, yeah.
They practically operate as one company, but their stock prices have been different. Doesn't quite make sense in a perfectly efficient market.
Wow, that's a head scratcher. So are you saying markets are just inherently irrational?
Well, not entirely, but behavioral finance definitely shows us that the human element, it matters a lot. Recognizing our own biases is key to, making smarter choices.
Right. So how do we avoid being our own worst enemies when it comes to investing? What kind of actionable advice does Malkiel offer? So we've kind of established that predicting the market, perfectly, is pretty tough. But Malkiel doesn't just, leave us hanging there, does he?
Nope. He gives us some actual advice. He even walks us through an experiment he did with his students to really show how hard it is to predict those market moves.
Oh, interesting. What did they do?
Okay, so he had his students create, stock charts, but instead of using real data, they flipped a coin. Heads, the price goes up. Tails, it goes down.
So, pure chance.
Yeah.
A 50-50 gamble. Sounds like my kind of stock analysis. What happened?
Well, it's pretty amazing. The charts, they ended up looking a lot like actual stock charts with, all the peaks and dips and trends you'd expect. And remember, it was all random.
Wow. So it's easy to see patterns, even when they're not really there.
Right. Our brains just love to find patterns, even when we're dealing with something as unpredictable as the stock market. Malkiel's point is that we can't really use past prices to predict the future.
Right. That's the weak form of the efficient market hypothesis we were talking about, right? Okay, but what about, really digging into a company's fundamentals, Can't we find some hidden gems that way?
That's a great question, and Malkiel dives into it. He looks at whether professional analysts with all their resources and expertise can really give us regular investors an edge. And, well, his findings are pretty interesting.
Okay, I love a good Wall Street myth-busting. What did he find? Lay it on me.
All right, so he studied earnings forecasts from, the top Wall Street firms, and he compared them to what the companies actually earned. And guess what? The analysts weren't much better than random chance.
Wait, seriously? Even the bigwigs on Wall Street, they can't predict earnings consistently.
Nope. It turns out that predicting the future of a business, even for these seasoned professionals, is a lot harder than it seems.
Why is that?
Well, for one thing, unexpected events can really throw things off, like black swan moments, stuff nobody could have predicted.
Right, right.
He uses this example of like the utility industry. They're usually pretty stable, but even their earnings can be affected by things like, I don't know, sudden changes in fuel costs or new regulations that pop up.
Right. Those unexpected events, they can really mess things up.
Totally. Then there's the issue of, shall we say, creative accounting.
Oh, you mean like those big accounting scandals we've seen?
Yeah. Malkiel brings up Enron, where, their shady accounting practices totally fooled investors.
So reading those financial statements is like walking through a minefield, huh?
It can be. Even when the numbers are accurate, you have to make a lot of assumptions about the future, like how fast a company will grow. Analysts can look at the same information and come to totally different conclusions.
So there's a subjective element to it all, even with all that data.
For sure. And then there's always the potential for, conflicts of interest.
Ooh, yeah.
Malkiel points out that a lot of analysts work for firms that, do business with the companies they're covering. So there can be pressure to issue positive ratings, even if they're not really warranted.
Right. Don't bite the hand that feeds you.
Exactly. So Malkiel's advice is don't just blindly trust analyst recommendations. Do your own research, form your own judgments.
Okay, so it sounds like predicting the market and picking individual stocks, it's a lot harder than it seems, even for the pros. So where does that leave us everyday investors? What's the best approach?
Well, like we talked about earlier, Malkiel's a big fan of index funds.
Right, right.
Especially those low-fee ones that track a broad market index like, I don't know, the S&P 500 or the Russell 3000.
Right, the set it and forget it approach. But, we were talking earlier about how maybe just sticking to the S&P 500, it might not be enough. What about those smaller companies, the ones that might have more room to grow?
That's a good point. Malkiel actually suggests broadening your idea of indexing, including funds that track wider market indexes.
Oh, okay.
Like the Russell 3000, the Wilshire 5000, things like that. They capture a much bigger slice of the market.
So cast a wider net, so to speak. What about international diversification? Is that something he recommends?
Oh, absolutely. He's a big proponent of putting a good chunk of your portfolio into international index funds, especially those focusing on emerging markets.
Oh, yeah. Emerging markets. Those are the ones with the potential for really high growth, right? But aren't they also riskier?
They can be, yeah. But Malkiel argues that often those higher potential returns outweigh that added risk, especially for younger investors who have more time to, ride out those ups and downs.
So a little bit of calculated risk for a potentially bigger payoff. Makes sense. What about like other investment options like bonds or real estate? Where do those fit in?
Okay, so for bonds, Malkiel definitely sees them as like a core part of a well-rounded portfolio, especially as you get closer to retirement. You want more stability.
Right, bonds for that steady income stream. But didn't we talk about how like inflation can eat away at those bond returns?
We did, yeah. That's why he suggests considering Treasury inflation-protected securities, or TIPS, for part of your bond allocation.
TIPS, those are the ones that adjust with inflation, right?
Exactly. They help protect your investment from, losing value because prices are rising.
No, that's nice. So stocks, bonds, TIPS. What about real estate? Where does that fit in?
Well, he sees real estate as a really good way to diversify and, potentially see some good appreciation. But he says you don't necessarily have to go out and buy a property.
Oh, I'm intrigued. How do you invest in real estate without owning any actual buildings?
He recommends looking into these things called real estate investment trusts, or REITs.
Oh.
Basically, they're companies that own and manage, properties that generate income, like shopping malls or office buildings or apartments.
Oh, okay.
So you buy shares in the REIT and you get dividends based on the rental income from those properties.
So it's like owning a little piece of a big real estate portfolio.
Exactly. And they're traded on stock exchanges, just like regular stocks, so they're pretty easy to buy and sell.
That's sort of convenient. Malkiel's like covering all the bases here.
Yeah.
Are there any other like asset classes he talks about?
He does mention gold, but he's not really a huge fan of it as a long-term investment. He acknowledges that it can act as a hedge against inflation or like a safe haven during uncertain times. But it doesn't generate any income, and its price can be really volatile.
So it's a bit of a gamble.
You could say that, yeah. He also advises against getting into like collectibles, art, antiques, things like that.
Right.
Their value is really subjective, hard to determine, and they can be difficult to sell quickly if you need to.
So stick with the tried and true investments like stocks, bonds, real estate.
That seems to be his preference, yeah.
Yeah.
And when it comes to actually putting together your portfolio with these asset classes, he really emphasizes customizing it to your own situation. Your age, how much risk you're comfortable with, what you're saving for.
Right. The whole life cycle investing thing, matching your investments to your stage of life.
Mhm.
But how do you figure out the right, asset allocation for you? Is there like a secret formula or something?
There's no one-size-fits-all answer. But he does give some general guidelines. For, younger investors, he suggests having a larger chunk in stocks, maybe like 80 to 90%.
So take advantage of that growth potential while you're young.
Exactly. And as you get closer to retirement, you gradually shift to a more conservative mix. Increase the proportion of bonds, decrease stocks.
Lowering the risk as you get closer to needing that money. That
Mm.
makes sense. Does he give like specific percentage recommendations for different ages?
Yeah, he's got a whole table in there outlining suggested allocations for different age ranges. Starts out stock heavy for the younger folks and gradually shifts to bonds as retirement gets closer.
Oh, that's cool. Like a roadmap for how to adjust your portfolio as you get older.
Think of it that way, yeah. But he really emphasizes that these are just guidelines. The ideal mix will depend on your own circumstances, your risk tolerance, your goals.
So personalized investing, not a one-size-fits-all.
Right. And along with having a plan, he also stresses the importance of, staying disciplined.
Oh, yeah.
Don't let emotions take over. He says investors often make really bad decisions when they let fear or greed call the shots.
Ugh, yeah, I've been there. Panic selling when the market takes a dip or chasing after those hot stocks when they're soaring. Emotions can definitely lead to bad choices.
For sure. Malkiel gives some really practical tips for staying disciplined, like sticking to your plan, avoid trying to time the market, and, keep your eyes on that long-term prize.
Solid advice. It's easy to get caught up in that day-to-day market drama, but, investing is a marathon, not a sprint, right?
Exactly. He also emphasizes, doing your research, understanding the risks, and not being afraid to seek advice from a financial professional when you need it.
So an informed and empowered approach to investing. I like that. We've covered a lot of ground here. Index funds, diversification, asset allocation. Anything else Malkiel highlights in this part of the book that we should touch on?
It's funny, though. After all that talk about efficient markets and how it's so hard to beat the averages, you'd think Malkiel would just tell everyone, put all your money in index funds and call it a day. But he actually gets it. For a lot of people, picking individual stocks is just too tempting.
Yeah, I get that. It's like the dream of hitting that investment home run, finding that hidden gem that just explodes in value. I can see why that's so alluring.
Yeah, totally. Malkiel understands that. He's not just like an academic living in an ivory tower. He's a realist.
Yeah.
And for those folks who, they want to try their hand at stock picking, he gives some pretty practical advice.
All right, I'm all ears. What wisdom does he offer to those brave souls venturing into the stock picking jungle?
Well, first, he reminds everyone of his core principle. Never pay more for a stock than its underlying value justifies.
Right back to the firm foundation theory. A company's stock price should reflect its true worth. But how do you actually figure out that intrinsic value? Isn't that kind of subjective?
It can be, for sure. But Malkiel suggests using a combination of, good old-fashioned fundamental analysis and a healthy dose of common sense.
Okay, so back to those financial statements and industry reports. What specifically should investors pay attention to, when they're trying to really size up a company?
He emphasizes looking at, a company's earnings, dividends, assets, the quality of its management team, and its competitive position within its industry.
So it's about looking at the big picture, not just focusing on one or two numbers.
Exactly. And he's really cautious about getting too excited about companies with, those sky-high price-to-earnings ratios, especially if they're based on, really optimistic growth projections.
Like those castles in the air.
Yeah.
Sometimes the market gets ahead of itself, pricing in growth that might never materialize.
Exactly. And Malkiel also warns about, getting caught up in those fads or chasing hot stocks that have already gone way up.
So resist the temptation to jump on that bandwagon, even when it feels like everyone else is getting rich quick.
Exactly. It's about sticking to your guns, doing your research, and not getting swept up in the hype.
That's easier said than done, though, right?
Yeah,
Especially when you're seeing other people seemingly making a killing.
I know. But Malkiel really believes that patience and discipline, those are the hallmarks of successful investors.
Okay, so let's say you've, done your homework, found a company that looks undervalued, you decided to take the plunge, buy some stock.
Yeah.
Any advice on how to manage that investment once you've taken the leap?
One thing he emphasizes is, setting realistic expectations. Stock prices can be really volatile in the short term. Even
Okay.
a good company can see its price drop for a while.
Right. The random walk in action, those unpredictable ups and downs, they're all part of the game.
Exactly. And Malkiel encourages investors to, focus on the long term. Don't freak out over short-term dips.
So ride out those market storms and don't, jump ship at the first sign of trouble.
Right. And he also suggests setting a target price for your investment and reevaluating your position if the stock hits that price or if your reasons for buying it in the first place have changed.
So have a plan, but be flexible, be ready to adapt.
That's the idea. And, he also reminds investors about the tax implications of buying and selling stocks. It's often better to hold on to winning stocks for longer, to get those lower long-term capital gains rates.
Right. Tax efficiency, that's definitely something to consider, especially if you're investing outside of like a retirement account.
For sure. So, while Malkiel recognizes that picking individual stocks can be fun and exciting and potentially rewarding, he's also a realist. It's not for everyone.
You got to have a pretty strong stomach for risk and volatility.
Definitely. And even if you are comfortable with risk, he still stresses the importance of diversification,
True.
even within a portfolio of individual stocks.
Right. Don't put all your eggs in one basket, even if it seems like a really promising basket.
Exactly. And he really cautions against, over trading. All those frequent buying and selling fees can really eat into your returns.
So be more thoughtful and deliberate about your stock picking. Don't just jump in and out of positions based on your gut feeling.
Exactly. Malkiel's a big believer in taking your time, really understanding your investments, making those informed decisions, and being patient.
Sounds like a solid approach.
Yeah.
So we've covered a lot of ground in our deep dive into a random walk down Wall Street, from, the big picture theories of how the market works to the nitty-gritty of picking stocks and building a diversified portfolio. Hopefully you've learned a thing or two that you can apply to your own investing.
Definitely. And remember, investing is a lifelong journey. The more you learn and the more you understand, the better prepared you'll be to achieve your financial goals.
Absolutely. Well said. Well, folks, that's going to wrap up our deep dive into a random walk down Wall Street. Until next time, happy investing.